Hey everyone, let's just get right into it. Today we're tackling Chapter 9 of your syllabus, Financial Markets. I know, looking at all these heavy economic terms and structures can feel kind of overwhelming at first glance, but honestly, it's like a giant puzzle. Once you see how the pieces fit, it's a beautifully simple, logical machine. Okay, let's dive into this. So, here is our roadmap for this explainer. First, we'll meet the financial market itself. Second, the fast-paced money market. Third, we'll explore the capital market. Fourth, the digital guardians, DMAT, depositories, and SEBI. And finally, you'll want to stick around for this. I've got some specific cheat code memory tricks for your board exams. All right, part 1. Meet the financial market. We really need to lock down the big picture before we start zooming in on the tiny details. So, what exactly is it? Well, the financial market is essentially an organized structure. It includes both the capital and money markets, and it has one massive job: mobilizing savings from society directly to industrial enterprises. You can think of it like a giant, highly efficient bridge. On one side, you've got households and investors sitting on savings. On the other side, businesses and industrial enterprises that desperately need those funds to grow. The financial market is the whole shebang, the overarching umbrella connecting those savers with those borrowers to literally fuel the entire economy. Now, this huge market splits into two totally different territories. On one side, you have the money market. This one is snappy, it's fast. We're talking short-term instruments with a maturity period of exactly 1 year or less. High liquidity, meaning it acts almost as a close substitute for cash itself. But then, in stark contrast, you've got the capital market. Take a breath, because this is where things slow down. It deals in long-term securities like shares and debentures. This is the market that actually drives the long-term economic growth of the country. So, fast liquidity on one side, grounded long-term growth on the other. That's the grand division we're dealing with.
Moving right along to Section 2, the money market and its instruments. We're putting a magnifying glass specifically on that fast-paced, short-term side of the financial world.
First up are Treasury bills, or T-bills. Listen closely to this part because T-bills pop up on exams all the time. A T-bill is issued by the RBI on behalf of the government. And here's the absolute crucial thing. They are zero-coupon bonds, meaning there's no regular interest paid out in the traditional sense. Instead, they're issued at a discount and redeemed at par. So, say you buy a T-bill worth 25,000 rupees, but you only pay 23,500 upfront. When it matures, you get the full 25 grand. That difference? That's your return. Oh, and keep in mind, they are always issued in multiples of 25,000. Next up, commercial paper. Now, unlike government-backed T-bills, these are unsecured, short-term promissory notes. Because there's no security, they are strictly issued by corporate institutions that are highly creditworthy. They use these to raise cash for anywhere from 7 days up to 1 year. And get this, the minimum entry requirement is 5 lakh rupees. That massive number tells you right away this is an exclusive instrument designed for big, financially strong corporations. Okay, let's quickly knock out two more vital instruments: certificate of deposits and commercial bills. Certificate of deposits, or CDs, are unsecured, negotiable instruments issued by commercial banks and financial institutions, starting at a minimum of 1 lakh rupees. They basically help banks secure short-term finance. Commercial bills, though, happen naturally during everyday business. When goods are sold on credit, the seller draws a bill. Once a commercial bank accepts it, boom, it becomes a negotiable commercial bill, usually for 30, 60, or 90 days. They're pretty much the lifeblood of daily business liquidity. All right, zooming into the absolute shortest end of the money market, stuff commercial banks primarily use to maintain their minimum cash reserves. Call money is exactly what it sounds like. It's an overnight interbank loan, one single day. But if that borrow and lend period stretches to anywhere between 2 and 14 days, it transitions into what we call notice money. Memorize those time frames forcefully. Call is 1 day, notice is 2 to 14 days. Okay, Section 3, exploring the capital market. We're pivoting smoothly from those rapid-fire short-term options into the vast long-term arena. And visualizing this hierarchy is seriously the best way to anchor your memory for the exam. Think of the financial market at the very top. We just totally conquered one half, the money market. Now look at the other half, the capital market. Notice how it splits further into the primary market and the secondary market. Walking through this hierarchy conceptually is the key to truly understanding how all these gears interlock. Let's clarify the difference between those two branches, because people get this mixed up a lot. The primary market, that's for newly issued securities.
It's where investors buy direct from the issuing company for the very first time, specifically to raise brand new initial capital. The secondary market is just the formal name for the stock exchange. This is where existing, already issued securities are traded back and forth between investors. Fun historical fact to keep in mind, India's oldest secondary market is the Bombay Stock Exchange, and it was formed way back in 1875.
Moving to Section 4, DMAT, Depositories and CBI. Now that we know where these securities trade, let's look at the modern mechanics and the watchdogs that actually keep the system transparent and safe. We'll start with the DMAT account. DMAT is basically just short for dematerialization, literally converting physical paper securities into electronic data. Decades ago, trading meant physically passing around these fragile paper certificates. Today, DMAT completely simplifies that. It's basically a highly secure, purely digital wallet for your shares.
But who actually holds and manages those electronic shares for you? That's where depositories come in. Let's break this down together, because this is prime multiple choice question material. India has two main ones. First is NSDL, the National Securities Depository Limited, registered with SEBI in 1996 as a public company under the Companies Act. Second is CDSL, the Central Depository Services Limited, incorporated a bit later in 1999, and it operates a centralized system monitoring every single transaction. Just think of them as giant, ultra-secure electronic vaults for the nation's securities.
Now, a purely digital trading system like this doesn't work without immense trust and oversight, right? Enter SEBI, the Securities and Exchange Board of India. They are the ultimate protective watchdog of the market. They have three brilliantly clear goals. First, protect the interests of investors, meaning everyday folks like us. Second, encourage the positive development of the whole securities market. And third, absolutely regulate that market. They ensure fair play, they block fraudulent trades, and they make sure corporate bodies are playing by the rules. Finally, Section 5, Board Exam Memory Tricks. We have covered a massive amount of technical ground today, but bring your peak energy right here because it's time for those legal cheat codes I promised you. Okay, picture this. You're sitting in the exam hall, staring at a blank piece of paper, trying to list the instruments of the money market. You only need to recall 5 letters. T, C, 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 C. That's it. Let's look at how this builds your perfect answer. Let's unpack the acronym RAPID FIRE. The T stands for Treasury bills. The first C, commercial papers. Second C, certificate of deposits. Third C, commercial bills. And that final C is call and notice money. TTCTCTCT. Burn those 5 letters into your brain, and you instantly unlock the 5 key money market instruments to secure full marks without breaking a sweat. You guys have totally mastered the big picture today. The rapid-fire money market, the foundational capital market, the digital depository mechanics, and SEBI's watchful eye. You even have the cheat codes to prove it. So I want to leave you with a provocative thought. Now that you understand exactly how these systems act as a bridge to mobilize society's funds, which market will your future savings go into? Are you going to lean towards the short-term, secure liquidity of the money market or the long-term, wealth-building growth of the capital market? Really think about it. Thanks for learning with this explainer. Keep studying smart, and I'll catch you on the next topic.